This podcast is brought to you by empor.top, the stories of top companies. Disclaimer. This AI-generated content is for informational purposes only and should not be considered as investment advice. Andreessen Horowitz, a16z. The story of software eating the world. Picture this moment, July 6th, 2009. The financial crisis still casts its long shadow over Silicon Valley. Traditional venture capital firms are pulling back, hoarding cash, waiting for the storm to pass. Yet on this day, two battle-tested entrepreneurs with the scars and successes of the dot-com era announced something audacious: a new venture capital firm with $300 million in initial capital at a time when others are contracting. Marc Andreessen and Ben Horowitz, the founders of this new firm called Andreessen Horowitz, weren't just launching another VC fund. They were architecting a complete reimagining of what venture capital could be. Andreessen, the boy wonder who'd co-created Mosaic and co-founded Netscape, had seen the internet revolution from the inside. Horowitz, who'd navigated the treacherous transformation of LoudCloud into Opsware before its $1.6 billion sale to HP, understood the brutal reality of building companies. Today, as of July 2025, Andreessen Horowitz ranks first on the list of venture capital firms by assets under management with $46 billion, a staggering transformation from that initial $300 million fund 16 years ago. This isn't just a story of financial returns, though those have been spectacular. It's the story of how two entrepreneurs who believed software is eating the world built the very machine that would feed that hunger, fundamentally reshaping not just venture capital, but the entire technology ecosystem. Think of this journey in distinct acts. First, the origin stories of two founders whose complementary experiences would define their approach. Then the early years, when a16z disrupted the cozy venture capital club with innovations borrowed from Hollywood talent agencies. Next comes the platform revolution, where they built something unprecedented, a full-service operation that made them as much company builders as investors. The narrative takes dramatic turns with their prescient crypto pivot in 2013, years before most VCs understood blockchain's potential, and their radical 2019 transformation into a registered investment advisor, breaking free from traditional VC constraints. We'll examine the boom years when their bets on companies like Coinbase and Airbnb delivered extraordinary returns, and the sobering corrections that followed. Throughout, we'll apply the rigorous frameworks of Porter's 5 Forces and Hamilton Helmer's 7 Powers to understand their competitive positioning, extracting the business lessons that matter for founders and investors alike. As we navigate through crypto winters and AI summers, through IPO bonanzas and market meltdowns, one question emerges. Has a16z permanently changed what it means to be a venture capitalist? Or have they simply been the right firm for a specific moment in technology history? The answer reveals as much about the future of innovation financing as it does about the past.
Marc Andreessen's journey to venture capital royalty began in the computer labs at the University of Illinois, where in 1993, at just 21 years old, he would help create something that would fundamentally change human civilization. Working at the National Center for Supercomputing Applications, NCSA, Andreessen co-authored Mosaic, the first widely used web browser, which revolutionized the World Wide Web through groundbreaking features such as inline image display and an intuitive graphical interface, making the internet accessible to mainstream users. Before Mosaic, the web was text, austere, academic, accessible only to the technically initiated. Andreessen's creation added pictures, intuitive navigation, and suddenly the internet became something your grandmother could use. But Andreessen's real education came with Netscape, the company he co-founded with Silicon Graphics founder Jim Clark in 1994. The Netscape story reads like a Silicon Valley thriller. The University of Illinois was unhappy with their use of the Mosaic name, so Mosaic Communications changed its name to Netscape Communications, and its flagship web browser became Netscape Navigator. The company's trajectory was meteoric. An IPO in 1995 that put Andreessen, barefoot, on the cover of Time magazine. The browser wars with Microsoft that would define an era of technology competition. And finally, Netscape's acquisition in 1999 for $4.3 billion by AOL. That sale might have seemed like defeat. Microsoft's Internet Explorer had won the browser wars through aggressive bundling with Windows. But Andreessen extracted crucial lessons from the experience: the importance of platform dynamics, the power of network effects, and, perhaps most importantly, the realization that being technically superior wasn't enough if you didn't have the right business model and strategic positioning. Meanwhile, Ben Horowitz was learning his own hard lessons in the crucible of the dot-com boom and bust. Horowitz co-founded Opsware, initially LoudCloud, in 1999, just in time for one of the most spectacular crashes in business history. The company that started as LoudCloud aimed to be the AWS of its time, providing infrastructure and hosting services to internet companies. When the bubble burst, Horowitz faced an existential crisis. His customers were disappearing, funding had dried up, and the company was burning through cash. What followed was one of the great pivots in Silicon Valley history. In 2002, Ben led a major transformation of the company. He sold the managed services part of the business to Electronic Data Systems, EDS, and changed the company's name to Opsware. This shift marked the beginning of its focus on enterprise software. The stock price fell to 35 cents per share. The market valued them at less than the cash they had in the bank. But Horowitz persisted, rebuilding the company around its data center automation software. In July 2007, Hewlett-Packard acquired Opsware for $1.6 billion in cash. The journey from near bankruptcy to billion-dollar exit had taught Horowitz invaluable lessons about resilience, the importance of culture during crisis, and the brutal decisions required to navigate a company through existential threats. These experiences would later inform his management philosophy and his best-selling book, The Hard Thing About Hard Things. Between their major company exits and founding a16z, both men stayed active in the startup ecosystem. Between 2006 and 2010, Marc Andreessen and Ben Horowitz invested $4 million across 45 startups, including notable companies like Twitter. This period established their reputation as super angel investors and laid the foundation for a16z. They were developing their investment thesis, building relationships, and most importantly, observing the inefficiencies in how traditional venture capital operated. These complementary backgrounds, Andreessen's product vision and platform thinking, Horowitz's operational excellence and crisis management expertise, would prove to be the perfect combination for reimagining venture capital. Where Andreessen saw the future, Horowitz knew how to build the machine to get there. Where Horowitz understood the grinding reality of operations, Andreessen could articulate the transformative vision that attracted entrepreneurs and limited partners alike. Together, they wouldn't just fund the future, they would systematically construct it.
The morning of July 6, 2009, marked more than just another fund launch in Silicon Valley. Andreessen and Horowitz launched their venture capital fund with an initial capitalization of $300 million at a moment when the conventional wisdom suggested pulling back, not pushing forward. The financial crisis had decimated portfolios, limited partners were skittish, and the venture capital industry was experiencing its worst contraction in decades. Yet Andreessen and Horowitz saw opportunity where others saw disaster. They recognized that great companies are often built during downturns. When talent is available, competition is reduced, and only the most committed entrepreneurs are still building. Their timing, which might have seemed foolhardy to some, was actually a masterclass in contrarian thinking. The early investment decisions revealed their strategy immediately. In 2009, Andreessen Horowitz made its first two investments, one in business management SaaS developer Aptio and one in Skype stock. According to Horowitz, the Skype investment was seen as risky by other experts in the field, who believed the company would be crippled by ongoing intellectual property litigation and direct competitive attacks from Google and Apple. The firm's founders viewed the investment as a success following Skype's sale to Microsoft in May 2011 for $8.5 billion. The Skype bet exemplified their approach, backing companies with strong network effects and platform dynamics, even when conventional wisdom suggested caution. While other VCs worried about legal challenges and competition from tech giants, Andreessen and Horowitz saw a product with hundreds of millions of users and irreplaceable consumer behavior patterns. Their analysis proved correct when Microsoft paid top dollar for those very network effects. By November 2010, just 16 months after launch, at a time when the field of venture capitalism was contracting, the company raised an additional $650 million for a second venture fund. In less than 2 years, the firm was managing a total of $1.2 billion. This rapid scaling sent shockwaves through Sand Hill Road. Traditional firms that had taken decades to reach similar assets under management watched as these newcomers compressed that timeline into months. The real disruption, however, wasn't just in the size of their funds, but in how they operated. Andreessen Horowitz Partners work on behalf of all its portfolio companies, an approach modeled after the Hollywood talent agency Creative Artists Agency. This CAA model was revolutionary in venture capital. Instead of partners operating as individual fiefdoms with their own portfolio companies, everyone at a16z worked for every portfolio company. The practical implications were profound. When a portfolio company needed to hire a VP of engineering, they didn't just get advice from their board member, they got access to a16z's entire recruiting operation. When they needed PR support for a product launch, there was a team ready to help. When they faced regulatory challenges, experts were on call. This wasn't the old boys club of Sand Hill Road, where success depended on who you knew. This was professionalized, systematized support. In 2011, Andreessen Horowitz invested $80 million in Twitter, becoming the first venture firm to hold stock in all 4 of the highest valued, privately held social media companies at the time: Facebook, Groupon, Twitter, and Zynga. This wasn't just portfolio construction, it was a statement of intent. While other firms might specialize or avoid competitive investments, a16z was betting on the entire social media revolution. The Twitter investment particularly showcased their approach to winning deals. They didn't just offer capital, they offered a comprehensive platform for growth. When Twitter was evaluating investors, a16z didn't pitch their fund. They pitched their ability to help Twitter recruit engineers, navigate regulatory challenges, and build enterprise relationships. They won not because they offered the highest valuation, but because they offered the most value beyond capital. These early years also established the firm's cultural DNA. They were entrepreneur-friendly to an almost radical degree. Terms were founder-favorable. They backed founders through pivots and crises. They publicly defended their portfolio companies when others might have distanced themselves. This wasn't just good business, though it certainly helped with deal flow. It was philosophical. Having been founders themselves, Andreessen and Horowitz built the firm they wished had existed when they were entrepreneurs. The early hits started validating their model. Beyond Skype's successful exit, their portfolio was showing remarkable momentum. Andreessen Horowitz also invested in Airbnb, Litro, Jawbone, Belly, Foursquare, Stripe, and other high-tech companies. Each investment wasn't just a bet on a company, but a bet on a broader thesis about how technology would reshape industries. By the end of 2011, less than 3 years after launch, Andreessen Horowitz had established itself not as another venture firm, but as something categorically different. They had disrupted the disruptors, bringing operational excellence and systematic support to an industry that had largely operated on reputation and relationships. The question was no longer whether they belonged in the top tier of venture capital. It was whether the top tier was big enough to contain what they were building.
The traditional venture capital model was elegantly simple. Smart people with money made bets on promising companies, joined their boards, and offered advice when asked. Andreessen Horowitz looked at this model and saw inefficiency everywhere. What emerged from 2011 to 2015 wasn't just an evolution of venture capital. It was a complete architectural redesign of what a venture firm could be. The numbers tell part of the story. As of March 27, 2014, the firm was managing $4 billion in assets following the closing of its 4th fund at $1.5 billion. But the real transformation was happening behind those numbers. A16z was building what they called a platform, a term borrowed from the technology world that perfectly captured their ambition to create network effects within their own firm. The platform consisted of specialized teams that would have seemed absurd at a traditional venture firm. There was a technical talent team, led by engineers who could evaluate technical candidates for portfolio companies. A marketing team that didn't just advise on marketing, but could actually execute campaigns. A business development team with relationships at Fortune 500 companies. A policy and regulatory affairs team that could navigate the increasingly complex intersection of technology and government. This wasn't window dressing. By 2014, a16z employed more operational specialists than investing partners. These weren't junior associates doing spreadsheet work. These were senior professionals who had run recruiting at major tech companies, led marketing at successful startups, or served in senior government positions. The cost structure was radically different from traditional VC firms, where most expenses went to a handful of partners. A16z was building what looked more like a professional services firm that happened to also invest. The GitHub investment crystallized their platform advantage. The company invested $100 million in GitHub, which netted over $1 billion for the fund when Microsoft acquired GitHub for $7.5 billion. But the story of how they won the deal is more revealing than the returns. When GitHub was raising money, multiple top-tier firms were competing. A16z didn't win on valuation. They won by demonstrating how their platform could help GitHub recruit engineers, build enterprise relationships, and navigate the complex dynamics of being a developer platform. They showed up to the pitch with specific people who would help with specific problems. In 2012, Andreessen Horowitz invested in 156 companies, including 90 in its portfolio and 66 startups through its funding of Y Combinator's Start Fund. This pace of investment would have been impossible without their platform. Traditional firms where partners handled everything from sourcing to support would have been overwhelmed. But a16z had industrialized the venture capital process. The 2013 vintage was particularly remarkable. In 2013, Andreessen Horowitz invested in Klinkle, Coinbase, Databricks, Lyft, Oculus VR, PagerDuty, Pixely, Ripple, Soylent, SwiftType, and Ubiome. Looking at this list in retrospect, it reads like a who's who of the next generation of technology companies. Coinbase would become the cryptocurrency exchange that brought crypto mainstream. Databricks would emerge as one of the most valuable private companies in the world. Lyft would help remake urban transportation. Oculus would pioneer virtual reality before being acquired by Facebook for $2 billion. Each of these investments benefited from the platform in different ways. Lyft needed help recruiting drivers and navigating city-by-city regulatory battles. A16z's policy team was instrumental. Databricks needed to build relationships with enterprises. The business development team opened doors. Coinbase needed to navigate the complex world of financial regulation. The regulatory affairs team had experts who had worked at Treasury and the SEC. The firm was also pioneering new investment approaches. In 2014, the firm led a $57 million Series B round in the A/B testing startup Optimizely. The same year, the company invested in several more companies, including Tanium for $90 million, BuzzFeed, and Forward Networks. These weren't just financial investments. Each came with a deployment of platform resources tailored to that company's specific needs. By 2015, the platform model was attracting attention and imitation. Other venture firms started building out operational teams, though few matched a16z's commitment and scale. In 2015, the firm invested $40 million in Stack Exchange, $2.8 million in Distelli, and $80 million in cloud-based CAD software company Onshape. Also in 2015, Andreessen Horowitz invested in the blogging platform Medium Samsara, Improbable, Honor, Inc., OpenBazaar, a blockchain startup, and nootropics and biohacking company Nutrabox. The breadth of these investments, from enterprise software to blockchain to biohacking, demonstrated another aspect of the platform advantage. Because they had specialized expertise in-house, they could evaluate and support companies across a wider range of industries than firms dependent on partner expertise alone. But the platform wasn't without critics. Some argued that a16z was burning money on overhead that should go to returns. Others suggested that the platform was more marketing than substance, that entrepreneurs didn't really need all these services. The conventional wisdom on Sand Hill Road was that a 16Z was playing a dangerous game, sacrificing returns for growth. The critics missed the strategic insight. The platform wasn't just about helping portfolio companies, though it certainly did that. It was about creating switching costs and network effects that would compound over time. Entrepreneurs who had experienced the platform became evangelists, referring other founders. The platform teams developed relationships and expertise that made a 16Z increasingly valuable to both entrepreneurs and limited partners. What looked like excessive overhead was actually investment in a sustainable competitive advantage that would be nearly impossible for competitors to replicate quickly.
The year was 2013, and Bitcoin was still largely dismissed as internet funny money, a curiosity for libertarians and tech enthusiasts. The price had crashed from over $250 to under $50 earlier that year. Most of Sand Hill Road saw cryptocurrency as somewhere between irrelevant and radioactive. Too volatile, too regulatory uncertain, too weird. Chris Dixon, who had joined a16Z as a general partner in 2012, saw something different. In 2013, Dixon led Andreessen's first investment in Coinbase as part of its $25 million Series B round after the crypto exchange graduated from Y Combinator. That same year, a16Z also conducted a $3 million Series A investment round for Coinbase, the first cryptocurrency exchange in the United States. At a time when most venture capitalists wouldn't touch crypto with a 10-foot pole, a16Z was placing what would become one of the defining bets in venture capital history. Dixon and Andreessen's thesis was elegant in its simplicity. The internet had revolutionized information transfer, but payment and value transfer remained stuck in the pre-internet age. Bitcoin and blockchain technology represented the missing protocol layer of the internet, a way to transfer value as easily as sending an email. While others saw speculation and volatility, they saw infrastructure for a new financial system. The Coinbase investment was just the beginning. That year, he also led Andreessen's investment in payments network Ripple Labs. Each investment taught them more about the crypto ecosystem, the technical challenges, regulatory complexities, and massive potential. They weren't just making financial bets, they were building expertise that would compound over years. Marc Andreessen himself became an eloquent spokesperson for the crypto thesis. His 2014 New York Times op-ed Why Bitcoin Matters laid out the case with characteristic clarity. Bitcoin was the first practical solution to a long-standing problem in computer science called the Byzantine generals problem. It enabled trust between parties without requiring a trusted central authority. This wasn't just about digital currency. It was about reimagining how human cooperation could work in the digital age. Between 2013 and 2018, while crypto went through multiple boom and bust cycles, a16Z quietly built what would become the most sophisticated crypto investment operation in venture capital. They hired experts from traditional finance who understood regulation. They brought in engineers who could evaluate blockchain protocols at the code level. They developed relationships with regulators, trying to help shape sensible policy rather than simply avoiding scrutiny. The commitment deepened with each passing year, even as crypto's public perception oscillated wildly between the future of money and Tulip Mania 2.0. By 2017, as Bitcoin reached nearly $20,000 before crashing again, a16Z had developed a contrarian view. The price volatility was noise, but the underlying technology development was signal. The number of developers building on blockchain, the quality of the projects, the sophistication of the infrastructure, all were improving exponentially even as prices crashed. This led to a decisive moment. In June 2018, a16Z closed a dedicated crypto fund with $300 million in capital commitments. The fund was designed to include the best features of traditional venture capital, updated to the modern crypto world. The timing seemed almost perverse. Crypto had just experienced one of its most spectacular crashes, with Bitcoin falling from nearly $20,000 to under $4,000, but that was exactly the point. We've been investing in crypto assets for more than 5 years. We've never sold any of those investments and don't plan to anytime soon. We structured the a16Z crypto fund to be able to hold investments for 10 plus years, wrote Chris Dixon at the time. The fund structure itself was innovative, designed to handle the unique challenges of crypto investing. Traditional venture funds were constrained in their ability to hold liquid tokens. Regulatory restrictions limited how much of a fund could be in liquid assets. The crypto fund was structured differently, able to hold tokens for long periods, participate in network governance, and support projects through multiple cycles. Leading the fund with Dixon was Katie Hahn, whose star had quietly been rising in the Bay Area. Hahn is kind of a big deal. She was the DOJ's first ever coordinator for digital assets and led investigations into the Mt. Gox hack and the task force that investigated and ultimately took down the online drug marketplace Silk Road. Her addition brought crucial regulatory expertise and credibility to a16z's crypto efforts. The portfolio they built during this period was remarkably prescient. Beyond Coinbase and Ripple, they invested in the infrastructure layer of crypto. OpenBazaar, CryptoKitties, which would pioneer NFTs, Dfinity, Anchorage, Oasis Network. These weren't speculation plays on token prices. They were bets on the fundamental building blocks of a new financial and internet infrastructure. The strategic importance of the crypto pivot extended beyond just returns. It positioned a16z at the forefront of what they believed would be the next major computing platform after mobile. It attracted a new generation of entrepreneurs who saw a16z as the only major firm that truly got crypto. It also set the stage for an even more radical transformation of the firm itself, one that would break the traditional boundaries of venture capital and establish a16z as something entirely new in the investment landscape. The crypto pivot wasn't just about catching a trend, it was about positioning for a fundamentally different future.
March 2019 arrived with a bombshell announcement that sent shockwaves through Sand Hill Road. Andreessen Horowitz will soon cease to be a venture capital firm, veering away from the majority of its Sand Hill Road neighbors in Silicon Valley to instead become a registered investment advisor, or RIA. The firm filed in March to become an RIA as it seeks greater flexibility in its investments, particularly when it comes to cryptocurrencies. To understand the magnitude of this decision, you need to understand the regulatory straitjacket that traditional venture capital firms operate within. Venture firms rely on an exemption that allows them to avoid the heavy regulatory requirements of registered investment advisors. But this exemption comes with strict limitations. No more than 20% of a fund can be invested in liquid securities, like publicly traded stocks or cryptocurrencies. For most VC firms, this trade-off made sense. They were in the business of investing in private companies anyway. But a16z wasn't most VC firms. They saw massive opportunities that the traditional VC structure simply couldn't capture. Crypto tokens that might fluctuate between liquid and illiquid. Secondary market purchases of shares in their own portfolio companies. The ability to hold public stocks after IPOs rather than being forced to distribute them. The chance to invest in other funds that might have exposure they wanted. The 20% limitation wasn't just constraining, it was strategically crippling for the future they envisioned. A16z opted to structure itself as a registered investment advisor, RIA. The main impetus behind this move was a greater ability to invest in the crypto ecosystem. But crypto was just the beginning. The RIA structure would fundamentally change what a16z could be. The transformation came with costs, serious ones. Employees would have to go through background checks and register their investment holdings. In addition, there would be more restrictions placed on what they could trade individually, as well as how they discuss financial performance. The firm would face SEC oversight and compliance requirements that venture firms had traditionally avoided. The paperwork, the scrutiny, the restrictions on personal trading. All of this was anathema to the freewheeling culture of venture capital. Yet Andreessen and Horowitz pushed forward. They understood something their critics missed. The venture capital industry's structure was a historical accident, not an optimal design. The exemptions and limitations made sense in an era when the lines between public and private, liquid and illiquid, equity and tokens were clear. But those lines were blurring rapidly. By becoming an RIA, Andreessen can put more money into areas like crypto, which often involves the purchase of tradable coins as opposed to equity, and can more freely allow analysts in different areas to communicate with each other, rather than being walled off. This wasn't just about regulatory flexibility, It was about organizational capability. The strategic implications rippled outward. It's possible that a 16Z may see an opportunity to ramp up its positions by buying these stakes from operators as companies stayed private longer and early employees sought liquidity. They could now participate meaningfully in these secondary transactions without bumping up against regulatory limits. The timing of the RIA transition also revealed sophisticated market thinking. The firm was in the process of raising a growth fund of $2 billion to $2.5 billion that's expected to close in the next few weeks. Andreessen was close to seeing some of its biggest returns, with Slack, Pinterest, and Airbnb all in the pipeline to go public. The RIA structure would allow them to manage these positions more strategically, holding when they believed in long-term value rather than being forced to distribute based on regulatory requirements. A 16Z transitioned their business model from a classic VC to an RIA in March of 2019 as they continue to double down on crypto-related investments. This wasn't just a regulatory maneuver, it was a philosophical statement about the future of technology investing. The competition watched with a mixture of fascination and horror. Some firms, like General Catalyst, quickly followed suit and filed to become RIAs. Others dismissed it as a 16Z, making things unnecessarily complicated. The traditional venture capital establishment particularly bristled at the implication that their structure was outdated. But a 16Z wasn't trying to win a popularity contest on Sand Hill Road. They were positioning for a future where the boundaries between different asset classes would continue to blur, where crypto protocols might issue tokens that acted sometimes like securities, sometimes like commodities, sometimes like currencies, where the best investments might require buying secondary shares, or holding public positions, or investing in other funds. As a firm, we have this massive ambition to be the best investor, period, and want the flexibility to invest in what we think is the best investment, Wenmacher said. This wasn't hyperbole. It was strategy. The RIA structure was the legal and regulatory foundation for a 16Z's ambition to transcend traditional category boundaries. The transformation also enabled a 16Z to better serve its limited partners. As an RIA, they could provide more sophisticated reporting, manage risk more effectively across different asset classes, and potentially access investors who couldn't invest in traditional VC funds due to their own regulatory constraints. What looked like added complexity was actually expanded capability, setting the stage for the massive fundraises and spectacular returns that would follow in the boom years ahead.
The year 2020 began with the world in lockdown, markets in freefall, and uncertainty everywhere. Yet for a 16Z's crypto thesis, the pandemic would prove to be an unexpected accelerant. As the Federal Reserve printed trillions in stimulus and institutions searched desperately for yield in a zero-interest world, cryptocurrency suddenly didn't look so crazy anymore. In fact, it started to look prescient. In 2020, the company announced the launch of a second crypto-focused fund worth $515 million. While others were pulling back, a 16Z was accelerating. The fund size was significant, larger than most firms' entire assets under management. But it was the timing that proved masterful. Bitcoin was trading around $10,000. Ethereum was building momentum for what would become the DeFi summer. NFTs were still a curiosity known mainly to crypto natives. The portfolio they built during this period reads like a greatest hits of the crypto boom. Notable investments include OpenSea, which received $100 million in a round led by a 16Z in July 2021, followed by a $150 million round of funding for Axie Infinity developer Sky Mavis. OpenSea would become the dominant NFT marketplace, processing billions in transaction volume at the peak. Axie Infinity would pioneer play-to-earn gaming, creating entire economies in virtual worlds. But the crown jewel of a 16Z's crypto portfolio was about to deliver returns that would vindicate every contrarian bet they had made. April 14, 2021, marked a watershed moment not just for a 16Z, but for the entire crypto industry. Coinbase's IPO opened at $381 a share with a $20 million Series A investment from 2013, leading to an $86 billion valuation at IPO, marking one of the firm's most lucrative exits. The Coinbase returns were staggering. Since Coinbase went public, a16z sold or distributed to LPs more than half its stake in the company. The value of those sales and transfers at the time they were made totaled around $5 billion. To put this in perspective, this single investment returned more than all the capital a16z had raised for its crypto funds up to that point. All told, the a16z family of funds invested in Coinbase 8 different times from 2013 to 2020, including in every primary financing since our initial investment. This wasn't just lucky timing. It was conviction combined with patient capital. While others had traded in and out of crypto positions based on price volatility, a16z had held and accumulated. The Coinbase IPO triggered a cascade of crypto success. The validation of a major crypto company going public at such a valuation opened floodgates of institutional interest. Suddenly, every major financial institution needed a crypto strategy. Every venture firm needed crypto exposure. The infrastructure and projects a16zers had been funding for years were perfectly positioned to capture this demand. The momentum seemed unstoppable. December 2020 had already seen Airbnb's IPO, where Andreessen Horowitz's $60 million investment in 2011 culminated in a $47 billion valuation at IPO. The firm's ability to generate massive returns across different categories, from sharing economy to crypto, seemed to validate their platform approach. In May 2022, the firm announced a $4.5 billion crypto fund. The firm said that $1.5 billion was allocated to seed investments, while the remaining $3 billion would be earmarked for venture investments. In August 2022, the firm announced it would invest about $350 million in Flow, a real estate organization begun by WeWork founder Adam Neumann. Flow's purported aim is to create a branded product in the housing market with consistent community features. The decision was met with some criticism due to Neumann's business issues during his time at WeWork. The Flow investment particularly raised eyebrows. Here was a16z at the very peak of the market, writing a $350 million check to Adam Neumann. The same founder whose spectacular failure at WeWork had become a cautionary tale about Silicon Valley excess. Critics saw it as proof that a16z had lost discipline, that they were throwing money at anything with a famous founder attached. But a16z's thesis was different. They saw Neumann as a founder who had learned expensive lessons and was applying them to a massive market, residential real estate, ripe for disruption. The size of the check reflected their RIA advantage. They could write growth stage checks that traditional VC firms simply couldn't match. The crypto fund's portfolio expanded beyond pure speculation plays. It's also invested in Layer 1 platforms including Near, Avalanche, Solana, and Optimism, DeFi protocols including Uniswap, Compound, and Maker, and CryptoKitties and NBA Top Shot developer Dapper Labs. This wasn't spray and pray investing. It was systematically building positions across every layer of the emerging crypto stack. Meanwhile, the traditional financial world was taking notice. A16z raised $9 billion across 3 funds earlier this year, at a frenzied time for supersized VC funds. Last week, the firm closed a $600 million fund dedicated to gaming. The ability to raise such massive funds reflected LP confidence that a16z had cracked the code on crypto investing. The boom reached absurd heights by late 2021. NFT projects were selling for millions. Crypto gaming companies were valued in the billions. DeFi protocols were processing hundreds of billions in volume. A16z portfolio companies were at the center of all of it. The firm that had started investing in crypto when Bitcoin was under $100 was now managing billions dedicated to the space. Yet storm clouds were gathering. Inflation was rising, the Fed was signaling rate hikes, and the everything bubble that had lifted all assets was about to meet reality. The question wasn't if a correction would come, but how severe it would be, and whether a16z's conviction in crypto would survive the inevitable crypto winter that lay ahead.
The reversal, when it came, was brutal in its swiftness and scope. By May 2022, the very month a16z announced its massive $4.5 billion crypto fund, the market had already begun its descent into what would become one of the most severe corrections in technology history. The firm that had seemed to have perfect timing suddenly appeared to have catastrophically mistimed the market. Coinbase, which debuted at an $86 billion valuation in April 2021, saw its market cap fall below $15 billion after a disappointing earnings report. The crown jewel of a16z's crypto portfolio had lost over 80% of its value. This wasn't just paper losses. It was a fundamental questioning of the crypto thesis itself. The carnage extended far beyond crypto. Robinhood is down over 75% from its IPO price, and Roblox has shed nearly half its value. Nearly every high-profile a16z portfolio company that had gone public during the boom was now trading at a fraction of its peak valuation. The firm that had generated the best returns in its history just a year earlier was now watching those gains evaporate. An October 2022 Wall Street Journal article titled Andreessen Horowitz went all in on crypto at the worst possible time reported that during the first half of 2022, the cryptocurrency fund founded by Dixon at Andreessen Horowitz had lost around 40% of its value, a decline much larger than the 10% to 20% drops recorded by other venture funds. The Twitter investment added insult to injury. The firm committed to $400 million in equity investment toward the acquisition of Twitter by Elon Musk that completed in October 2022. According to the Washington Post, by September 2024, the firm had lost $288 million on its Twitter investment. The investment in Musk's chaotic transformation of Twitter into X seemed to exemplify a troubling pattern. A16z backing celebrity founders regardless of the business fundamentals. Yet beneath the headlines of losses and markdowns, A16z was adapting with characteristic strategic sophistication. The market correction, painful as it was, actually validated several of their key strategic decisions. The RIA structure allowed them to hold positions rather than being forced to sell into a declining market. There were long-term fund structures meant they didn't face the immediate redemption pressures hitting hedge funds and liquid crypto funds. The firm began repositioning for what they saw as the next major platform shift, artificial intelligence. While maintaining their crypto investments, they started deploying capital into AI infrastructure, foundation models, and application layers. This wasn't abandoning crypto for the next hot thing. It was recognizing that AI and crypto might be complementary technologies in building the next generation of the internet. The flow investment, widely mocked when announced, began to look more strategic as the residential real estate market faced its own challenges. High interest rates made home ownership increasingly difficult, potentially accelerating the rental and flexible living trends that Flow was targeting. Sometimes being contrarian meant being early and wrong before being right. A16z also used the downturn to double down on areas others were abandoning. In crypto, they continued investing, but shifted focus from consumer applications to infrastructure and enterprise use cases. They recognized that crypto's killer applications might not be NFT profile pictures, but programmable money, decentralized infrastructure, and new financial primitives. The firm's response to criticism was notably different from the past. Where once Marc Andreessen and Ben Horowitz were prolific on social media and in the press, they became increasingly insular. Andreessen blocked journalists and critics on Twitter. The firm launched its own media properties, attempting to control the narrative directly rather than engaging with traditional tech media. This insularity reflected a deeper shift in Silicon Valley's relationship with the broader world. The industry that had once welcomed scrutiny as a sign of relevance now saw it as a threat to be managed or avoided. A16z, always a leading indicator of Silicon Valley sentiment, was pioneering a new model: build your own media, create your own narrative, engage only on your terms. The portfolio companies adapted too, often painfully. Many conducted layoffs, cut burn rates, and refocused on profitability over growth. The a16z platform, built to help companies scale rapidly, had to pivot to helping them survive. The recruiting team that had helped companies hire aggressively was now helping them manage layoffs sensitively. The marketing team that had helped companies launch was helping them communicate through crisis. Despite the carnage, a16z's fundamental position remained strong. They had dry powder, billions in undeployed capital raised during the boom. They had portfolio companies that, while marked down, were still building important technologies. Most importantly, they had the patient capital structure to wait for recovery rather than being forced to realize losses. The correction also revealed something important about a16z's evolution. They were no longer just a venture capital firm, even in the expanded sense they had pioneered. They were becoming something new, a permanent capital vehicle for technology innovation, capable of investing across stages, asset classes, and market cycles. The losses of 2022 to 2024 were painful, but they were also tuition for learning how to operate this new kind of investment platform. The question was whether limited partners would maintain faith long enough for the strategy to prove itself.
As markets stabilized in 2024 and moved into 2025, Andreessen Horowitz emerged from the correction not diminished but transformed, revealing the true scale of their ambition. As of May 2024, Andreessen Horowitz has established itself as the preeminent venture capital firm, managing an impressive $42 billion in assets. In 2024, a16z further strengthened its market position by raising $7.2 billion across 5 distinct funds. But the headline number that truly captures a16z's current position came in July 2025. Andreessen Horowitz ranks first on the list of venture capital firms by assets under management, with $46 billion. This wasn't just growth, it was dominance. The firm that had started with $300 million just 16 years earlier now managed more assets than many established private equity firms. The leadership evolution tells its own story of strategic positioning. The firm's general partners include John O'Farrell, Scott Weiss, Jeff Jordan, Peter Levine, Chris Dixon, Vijay Pandey, Martin Casado, and Andrew Chen. Ex-VMware CEO Raghu Raghuram joined the firm as general partner in October 2025. The addition of Raghuram, who had led one of the most successful enterprise software companies through multiple transformations, signaled a16z's continued push into enterprise technology even as they maintained their consumer and crypto focus. The portfolio composition revealed sophisticated hedging across multiple technology waves. According to Root Data, as of January 15th, 2025, a16z's largest holding is UNI, with approximately 44 million tokens valued at $575 million. Compi is its second largest holding, with 255,000 tokens worth approximately $19.82 million. Despite the crypto winter, they had maintained and even expanded their DeFi positions, betting on the infrastructure layer of decentralized finance. The AI investments showed similar conviction. The firm's investments in industry leaders such as OpenAI, Databricks, and Scale AI, which have achieved remarkable valuations of $29 billion, $43 billion, and $7.7 billion respectively, highlight their acumen in identifying high-potential sectors. They weren't just chasing AI hype, they were systematically investing across the stack, from foundation models to infrastructure to applications. In 2023, the firm launched a $600 million American Dynamism Fund with the broad aim of supporting companies building in the nation's interest. This wasn't just portfolio diversification. It was a bet that the intersection of technology and national security would define the next decade. Defense tech space, energy manufacturing, sectors that traditional Silicon Valley had ignored, were now central to a16z's thesis. The fund structures themselves had evolved to match the ambition. As of 2025, a16z has more than $74 billion in assets under management across multiple funds, with more than $7.6 billion in committed capital for crypto funds. The ability to deploy capital at this scale across different asset classes and stages gave a16z unique strategic flexibility. Current deployment strategies reflected lessons learned from the correction. Rather than chasing valuations higher, they were focusing on building positions in fundamental infrastructure. Based on a16z's article, 7 Big Ideas for 2025, the major investment directions include stablecoins and global payments, small and medium-sized enterprises leading adoption of stablecoin payments, creating new investment opportunities for innovation, and adoption of cryptocurrency payment technologies. The gaming and consumer investments showed renewed confidence in user-facing applications. On October 15, 2024, a16z joined a $42.7 million funding round for Azra Games, a studio specializing in role-playing games, RPGs. The studio is working on Project Legends, an ambitious RPG integrating NFT and blockchain technology. Azra Games plans to launch the game first on mobile platforms. But perhaps the most interesting evolution was in how a16z thought about its own role. Andreessen describes his firm as a portal where entrepreneurs enter the matrix, a place where people can cut through the expectations and barriers of conventional business reality and shape the universe to their will. This wasn't just Silicon Valley hyperbole. It was a statement of intent about building a parallel infrastructure for innovation. The operational machine had grown to match the ambition. The firm now employed hundreds of people, most of whom weren't investors but operational specialists. The platform that had seemed like expensive overhead during the early years had become a differentiating asset, particularly valuable during turbulent times when portfolio companies needed more than just capital. Looking forward, a16z's positioning seemed designed for a world of continued volatility and platform shifts. They had the capital to invest through cycles. They had the operational infrastructure to support companies through challenges. They had the regulatory flexibility to invest across asset classes. Most importantly, they had constructed a narrative. Software eating the world, followed by crypto eating money, followed by AI eating everything, that gave them permission to invest in almost anything that seemed sufficiently transformative. The question facing a16z wasn't whether they could continue to grow or the fundraising machine seemed unstoppable. It was whether they could generate returns at scale that justified the massive capital deployment. The transition from insurgent to incumbent, from disruptor to establishment, brought its own challenges. But if the past 16 years had proven anything, it was that betting against Andreessen Horowitz's ability to reinvent the rules was usually a losing proposition.
Porter's 5 Forces analysis. When Michael Porter developed his 5 Forces framework, he probably didn't envision applying it to venture capital, an industry that seemed to operate more on relationships and reputation than traditional competitive dynamics. Yet, examining a16z through this lens reveals why they've achieved such dominance and where vulnerabilities might lie. Threat of new entrants. The barriers to starting a venture firm are paradoxically both low and high. Low because anyone with capital can declare themselves a VC. Witness the explosion of solo GPs and microfunds. High because building what a16z has built, the platform, the brand, the network effects, requires massive capital and time investment. A16z's most recently announced fund from earlier this year claimed $7.2 billion of assets under management. Assuming standard VC terms, 2% fee, 1% step-down fee, 10-year fund term, a16z would make $144 million per year in fees alone. If you add up the fees from every one of its reported funds, this year it stands to make about $700 million in fees alone. This fee base funds a platform that new entrants simply cannot replicate quickly. Bargaining power of suppliers, entrepreneurs. This has shifted dramatically over a16z's lifetime. Initially, entrepreneurs had limited options for funding. Today, they can choose from thousands of funds, raise from angels on rolling funds, or even bypass traditional funding through tokens. Yet a16z maintains strong positioning through differentiation. Entrepreneurs aren't just choosing capital, they're choosing access to a machine that can help them recruit, market, navigate regulation, and scale globally. The platform creates switching costs that pure capital cannot match. Bargaining power of buyers, limited partners. LPs have moderate but growing power. They seek returns but have limited options for top-tier venture exposure. A16z's consistent ability to raise massive funds suggests LPs still see value, but the recent markdowns have increased scrutiny. We've been impressed with them and their partners, but no matter how good the brand is, if a firm becomes too big and is no longer performing, we will leave it, one investor said. The relationship is symbiotic but increasingly transactional. Threat of substitutes. This is where disruption theory becomes relevant. Corporate venture arms, sovereign wealth funds, family offices, and even DAOs now compete for deals. More fundamentally, the entire venture model faces substitution from new financing mechanisms, ICOs, token launches, revenue-based financing, and crowdfunding. A16z's RIA transformation was partly a recognition that the traditional VC model itself might be substituted. Competitive rivalry. The intensity here has ratcheted up dramatically. Sequoia, Benchmark, and Founders Fund compete at the high end. Tiger Global and Coatue brought hedge fund aggression to venture. International funds like SoftBank deployed capital at unprecedented scale. Yet a16z's response, building a platform that's part venture firm, part investment bank, part consulting firm, has created a unique position that's difficult to directly compete against. Hamilton's 7 Powers Analysis. Hamilton-Helmers framework provides an even richer analysis of a16z's strategic position, revealing the sources of their persistent differential returns. Network effects. This is a16z's most powerful moat. Each successful portfolio company strengthens the network, attracting better entrepreneurs who achieve better outcomes, which attracts more capital and talent. The platform teams develop relationships that benefit all portfolio companies. Alumni of portfolio companies become founders who return to a16z for funding. It's a virtuous cycle that compounds over time. Scale economies. Andreessen Horowitz is now reportedly raising a $20 billion fund. If successful, this new fund will net the firm another $400 million per year on fees alone during the investment period. The platform costs are largely fixed. Adding another portfolio company doesn't require proportionally more recruiters or marketing specialists. This creates massive operating leverage that smaller funds cannot achieve. Switching costs. Once an entrepreneur takes a16z money, extracting themselves from the platform is difficult and costly. Board seats, information rights, and deep integration with platform services create lock-in. For LPs, the switching costs are more about opportunity cost. Walking away from a16z means losing access to their deal flow and returns. Branding. The a16z brand has become synonymous with Silicon Valley success. The Coinbase investment, which valued the company at $125 million in 2013, would become Andreessen Horowitz's highest returning. When Coinbase went public via direct listing in April 2021, a16z returned $4 billion in Coinbase shares to investors. The massive windfall has earned the firm a reservoir of investor goodwill. This brand drives deal flow, attracts talent, and provides pricing power in negotiations. Cornered resource. Marc Andreessen and Ben Horowitz themselves are cornered resources. Their experience, networks, and judgment cannot be replicated. But a16z has also cornered other resources. Specific talent with deep expertise in crypto, AI, and bio, relationships with key corporate partners, and perhaps most importantly, patient capital willing to invest through cycles. Process power. The platform itself represents embedded process power. The systems for evaluating deals, supporting portfolio companies, and managing funds have been refined over thousands of investments. The RIA transformation required building entirely new compliance and operational processes that competitors would struggle to replicate while maintaining their existing operations. Counterpositioning. The RIA structure is the ultimate counterpositioning move. Traditional VCs literally cannot follow without abandoning their existing structure and accepting massive new compliance costs. This allows a16z to pursue opportunities like holding public positions, buying secondary shares at scale, or investing in tokens that competitors cannot match without fundamental restructuring. The combination of these forces and powers reveals why a16z has achieved such dominance, but also hints at potential vulnerabilities. Size itself might become a constraint. The scale economies that provide advantage also make it harder to generate venture scale returns. The very platform that creates switching costs also creates organizational complexity and overhead. The brand that attracts deals also attracts scrutiny and criticism. Understanding these dynamics isn't just academic. It's essential for predicting how a16z will evolve and where disruption might emerge.
The Andreessen Horowitz story isn't just a chronicle of successful investments. It's a masterclass in strategic innovation and organizational design. The lessons extracted from their journey apply far beyond venture capital. offering insights for any business-facing platform shifts, competitive disruption, or scaling challenges. The power of founder-operators as capital allocators. The conventional wisdom in finance suggests that the best investors are those who've spent their careers studying markets and analyzing deals. A16z shattered this notion. Andreessen's experience building Netscape and Horowitz's journey through the loud cloud opsware transformation gave them pattern recognition that pure investors couldn't match. They understood the emotional roller coaster of entrepreneurship, the tactical challenges of scaling, and most importantly, the difference between what looks good in a pitch deck and what actually works in practice. The lesson: domain expertise from actual operation creates alpha in investing that financial analysis alone cannot generate. Building competitive advantage through services, not just capital. When a16z launched, venture capital was already commoditized. Money is money. Their insight was that entrepreneurs didn't just need capital, they needed capability. The platform model, recruiting, marketing, business development, regulatory support, transformed venture capital from a financial product into a comprehensive service. This wasn't just differentiation. It was creating switching costs and network effects that compounded over time. The broader lesson: in commoditized industries, bundling complementary services creates defensibility that the core product alone cannot provide. Timing market cycles, the courage to be contrarian. A16z's greatest returns came from investing when others were retreating. They launched with $300 million in July 2009, then raised an additional $650 million in November 2010 at a time when the field of venture capitalism was contracting. They launched their first crypto fund in 2018 during crypto winter. They announced their largest crypto fund in May 2022 as the market was crashing. This wasn't luck, it was discipline. The lesson: the best opportunities emerge when capital is scarce and sentiment is negative. But this requires both conviction and patient capital structure. The importance of platform shifts. A16z's history is essentially a series of bets on platform shifts: web, mobile, cloud, crypto, AI. They understood that new platforms create new winners, resetting competitive dynamics and creating openings for insurgents. Their willingness to invest heavily in understanding and building expertise in emerging platforms, even when they seemed fringe or speculative, positioned them to capture outsized returns. The lesson: platform shifts are rare but transformative. Organizations that identify and commit to them early can achieve generational success. When to break the rules: strategic rule-breaking versus recklessness. The RIA transformation exemplified strategic rule-breaking. Andreessen Horowitz will soon cease to be a venture capital firm, veering away from the majority of its Sand Hill Road neighbors. This wasn't contrarianism for its own sake. It was recognizing that existing rules constrained their strategy. The lesson: rules and industry structures often reflect historical accidents rather than optimal design. Breaking them requires understanding why they exist, what purpose they serve, and what capabilities you need to operate outside them. Portfolio construction in volatile markets. A16z's approach to portfolio construction evolved from concentrated bets to systematic diversification across stages, sectors, and asset classes. They learned that in volatile markets, optionality matters more than optimization. Having investments across the entire stack, infrastructure, platforms, applications, created natural hedges and multiple ways to win. The lesson: in uncertain environments, breadth of exposure to different scenarios outweighs precision in predicting which scenario will occur. Building and maintaining brand in professional services. A16z understood that in professional services, brand isn't just marketing. It's a business model component. Their brand attracted deal flow, enabled pricing power, and created benefit of the doubt during difficult periods. They built it through consistent thought leadership, public advocacy for their sectors, and careful cultivation of success narratives. The lesson: in industries where trust and reputation drive decisions, brand building is not overhead, it's investment in future revenue. The platform paradox: scalability versus flexibility. As a16z scaled, they faced the classic platform paradox. The very standardization that enables scale can reduce flexibility for unique situations. Their solution was to maintain the platform for common needs while creating specialized teams for emerging areas. The lesson: platforms should be designed with escape valves, ways to handle edge cases without compromising the core system's efficiency. Capital structure as strategic enabler. The evolution from traditional VC to RIA wasn't just regulatory, it was strategic. The ability to hold positions longer, invest across asset classes, and maintain flexibility in deployment created options that competitors couldn't match. The lesson: capital structure isn't just about funding, it's about strategic flexibility. Organizations should design their financial architecture to enable their strategy, not constrain it. The importance of narrative in technology investing. Software is eating the world wasn't just a blog post. It was a narrative that justified and explained a16z's entire investment strategy. It gave entrepreneurs a framework for understanding their role, LPs a reason to invest, and the firm itself a North Star for decisions. The lesson: in industries driven by future possibilities rather than current realities, narrative isn't just communication, it's strategy. The story you tell shapes the reality you create. These lessons reveal that a16z's success wasn't accidental or simply about being in the right place at the right time. It was about systematically building capabilities, taking calculated risks, and most importantly, recognizing that the rules of the game itself could be changed. Whether you're building a startup, managing a fund, or leading any organization through transformation, these principles provide a framework for thinking about competitive advantage, strategic positioning, and the courage required to build something truly different.
Bull case: the perpetual innovation machine. The optimistic view of Andreessen Horowitz sees a firm that has successfully transformed itself from venture capital insurgent to innovation infrastructure, positioned to capture value from every major technological shift for decades to come. The numbers alone tell a compelling story. From $300 million to $46 billion in assets under management in just 16 years, with the scale and scope to compete with anyone globally. The firm's unmatched dry powder positions them perfectly for the current market environment. While others retreated during the 2022 to 2024 correction, a16z has billions in undeployed capital ready to invest at more rational valuations. History suggests that vintage years during downturns produce the best returns, and a16z is positioned to make 2024 to 2026 defining vintages. Their patient capital structure, enabled by the RIA transformation, means they can hold positions for decades rather than being forced to exit prematurely. Their early positioning in transformative technologies, crypto, AI, bio, American dynamism, represents asymmetric upside potential. Chris Dixon founded and leads a16z Crypto, which invests in Web3 technologies through 4 dedicated funds with more than $7 billion under management. If even one of these bets plays out as they envision, the returns could dwarf everything that came before. The crypto infrastructure they've funded is becoming the rails for a new financial system. Their AI investments span from foundation models to applications, positioning them for whatever configuration of the AI revolution emerges. The platform model, once dismissed as expensive overhead, has proven its value through cycles. During booms, it helps portfolio companies scale faster than competitors. During busts, it helps them survive when others fail. This creates a compounding advantage as portfolio companies succeed more often, creating better returns, attracting better entrepreneurs, generating better deal flow. It's a flywheel that becomes more powerful with each rotation. Perhaps most importantly, a16z has demonstrated remarkable strategic adaptability. The transformation from VC to RIA, the pivot into crypto before it was obvious, the platform innovation, each represents successful navigation of a major strategic inflection point. This organizational capability to reinvent while maintaining momentum might be their most valuable asset. As technology continues to evolve in unpredictable ways, a16z's ability to evolve with it positions them to capture value regardless of which specific technologies win. The track record validates the model. Despite recent markdowns, the historical returns remain extraordinary. 7 months after Coinbase's Series A, Andreessen Horowitz led a $25 million Series B, buying shares at $1 apiece. They continued to build their stake, even buying some shares from Union Square. In total, Union Square divested about 28% of its stake in 5 separate transactions, and the 3.52 million shares it sold to Andreessen are now worth a combined $1.2 billion. One investment returning billions demonstrates the power law dynamics that drive venture returns. Bear case. The Icarus paradox. The pessimistic view sees a firm that has grown too large, too complex, and too removed from what made it successful, flying too close to the sun with wings made of fee income rather than carry. The very scale that bulls celebrate might be the source of ultimate underperformance. Size fundamentally constrains returns in venture capital. To move the needle on $46 billion in AUM requires massive exits, multiple $10 billion plus outcomes. But the universe of companies that can generate such returns is limited, and competition for them is fierce. You can't cost-effectively deploy $20 billion in small, high-alpha, early-stage rounds. It needs to deploy big numbers, so that it can raise even bigger funds. The math of venture returns suggests that a 16Z size might have already crossed the threshold where generating venture-scale returns becomes structurally impossible. Recent high-profile losses and questionable decisions raise concerns about investment discipline. The firm committed to $400 million in equity investment toward the acquisition of Twitter by Elon Musk. By September 2024, the firm had lost $288 million on its Twitter investment. The flow investment in Adam Neumann, the massive crypto fund raised at the market peak, these suggest a firm chasing deals for deployment rather than return potential. The increased regulatory scrutiny that comes with RIA status adds complexity and constraints that traditional VCs don't face. Every investment decision now involves compliance considerations. Every communication is potentially subject to regulatory review. This overhead might slow decision-making in an industry where speed often determines success. The very flexibility the RIA structure provides might be offset by the bureaucracy it requires. Competition has evolved and intensified. Tiger Global and Coatue brought hedge fund aggression and speed to venture. Solo GPs and rolling funds offer founders more favorable terms and faster decisions. Corporate venture arms have deeper pockets and strategic value. Sovereign wealth funds deploy capital at scales even a 16Z can't match. The competitive advantages that seemed insurmountable 5 years ago now face erosion from multiple directions. The platform model, while valuable, might be reaching diminishing returns. Many of the services a16z had pioneered are now available from specialized providers. Founders can access world-class recruiting, marketing, and advisory services a la carte. The overhead of maintaining hundreds of non-investing professionals might become a burden rather than an advantage, especially if returns disappoint and fee income comes under pressure. Most fundamentally, a 16Z might be fighting the last war. They built the perfect machine for the post-2008 era of zero interest rates, abundant capital, and software eating the world. But that era has ended. The new environment, higher rates, AI disrupting software itself, geopolitical fragmentation, regulatory scrutiny might require different capabilities than those a 16Z has built. Their very success might have created organizational inertia that prevents the next transformation. The synthesis view. The reality likely lies between these extremes. A 16Z has built something unprecedented in venture capital, a platform for systematic innovation support that operates at global scale. This positions them well for a world where technology continues to drive economic value creation. However, the challenges of size, complexity, and competition are real and growing. The key question isn't whether a 16Z will survive. Their AUM and fee base ensure that. It's whether they can continue to generate returns that justify their position and valuations. The next 5 years will likely determine whether a 16ZL represents the future of venture capital or the peak of a particular model that worked in a specific historical moment. Their ability to navigate this transition while maintaining strategic flexibility and investment discipline will determine which narrative proves correct.
The artificial intelligence revolution has arrived with a force that makes previous platform shifts look gradual by comparison. For a16z, this represents both vindication of their platform thesis and an existential test of their ability to maintain relevance at massive scale. The firm's investments in industry leaders such as OpenAI, Databricks, and Scale AI, which have achieved remarkable valuations of $29 billion, $43 billion, and $7.7 billion, respectively, position them at the epicenter of the AI transformation. But AI presents a fundamentally different investment challenge than previous platform shifts. The capital requirements are staggering. Training foundation models costs hundreds of millions. The competitive dynamics are unprecedented, with big tech companies deploying resources that dwarf even a16z's considerable firepower. Most challengingly, the pace of change is so rapid that investments can become obsolete between funding rounds. A16z's response reveals strategic sophistication. Rather than just backing model builders, they're investing across the entire AI stack: infrastructure, tools, applications, and safety. They recognize that while foundation models might become commoditized, the ecosystem around them will create massive value. Their platform advantage becomes particularly valuable here, helping AI companies navigate the complex technical, ethical, and regulatory challenges that define the space. The continued crypto commitment despite market volatility demonstrates either admirable conviction or dangerous stubbornness, depending on your perspective. By January 15, 2025, a16z crypto had amassed over $7.6 billion in assets under management. While crypto prices have recovered from their 2022 lows, they remain well below peaks. Yet a16z continues to invest, focusing on infrastructure and enterprise use cases rather than consumer speculation. A16z may focus on innovative solutions combining blockchain and traditional finance, such as bringing government bonds on-chain. Introducing government-backed digital assets, for example, digital bonds, to blockchain could provide more stable collateral for decentralized finance, DeFi. This represents a maturation of the crypto thesis, from disrupting traditional finance to integrating with it. The American Dynamism Fund represents another strategic evolution. In 2023, the firm launched a $600 million American Dynamism Fund with the broad aim of supporting companies building in the nation's interest. This isn't just portfolio diversification. It's recognition that the intersection of technology and geopolitics will define the next decade. Defense technology, space, energy infrastructure. These sectors require different expertise and networks than consumer internet companies. International expansion considerations add another layer of complexity. While a16z has remained primarily U.S.-focused, the global nature of technology innovation increasingly requires international presence. Yet expanding internationally means navigating different regulatory regimes, cultural contexts, and competitive dynamics. The firm faces a classic strategic dilemma: remain focused and potentially miss opportunities, or expand and risk losing what makes them special. The next generation of partners and succession planning looms as perhaps the most critical long-term challenge. Ex-VMware CEO Raghu Raghuram joined the firm as general partner in October 2025, bringing enterprise expertise. But the deeper question is whether a16z can maintain its culture and edge as founders age and new partners join. Many great venture firms have struggled with generational transitions. A16z's systematic approach might make them more resilient. But the cult of personality around Andreessen and Horowitz creates unique succession challenges. The fundraising environment has shifted dramatically from the exuberance of 2021. Limited partners, burned by markdowns and facing their own liquidity challenges, are more selective. The days of raising multi-billion-dollar funds in weeks are over, yet a16z's position might actually strengthen in this environment. Their established LP relationships, track record, and platform differentiation matter more when capital is selective rather than abundant. Looking ahead to 2026 to 2030, several scenarios seem plausible. In the optimistic case, AI and crypto converge to create entirely new categories of companies, and a16z's early positioning allows them to capture disproportionate value. The platform model proves its worth in helping companies navigate increasing complexity. Returns justify the scale. And a16z becomes the first truly global technology investment platform. In the pessimistic case, the firm becomes a victim of its own success. Size constraints returns to pedestrian levels. The best entrepreneurs choose smaller, more agile firms. The platform becomes bureaucratic overhead rather than competitive advantage. A16z remains large and profitable but loses the edge that made it special. The most likely scenario incorporates elements of both. A16z will probably continue to evolve, perhaps spawning separate entities for different strategies. A return to early-stage investing through a new vehicle, international expansion through partnerships, deeper specialization in specific sectors. The firm might look very different in 5 years, but the core insight that technology companies need more than capital to succeed will remain valid. The recent announcement of plans to raise additional massive funds suggests confidence in their model. But the real test won't be fundraising ability. It will be whether they can generate returns that justify the size. In an industry built on power laws where a few massive winners drive all returns, a16z has structured itself to need more winners than probability might provide. Their future depends on whether they can bend those probabilities through platform advantages, strategic positioning, and the operational excellence that has defined their first 16 years.
Standing at the intersection of Sand Hill Road and history, Andreessen Horowitz represents something far more significant than just another successful venture capital firm. They have fundamentally altered the physics of innovation financing, transforming venture capital from a cottage industry of wealthy individuals making bets into an industrial-scale platform for company building. The question isn't whether they changed the industry, they indisputably did, but whether that change represents evolution or revolution, and whether it's sustainable or ephemeral. The legacy of a16z transcends their impressive returns and massive AUM. They proved that venture capital could be operationalized, systematized, and scaled without losing the entrepreneurial essence that makes it valuable. Every major venture firm now has platform services, though few match a16z's commitment. The idea that VCs should provide more than capital has become table stakes. In this sense, a16z didn't just win the game, they changed the rules everyone else plays by. Yet the tension between growth and returns remains unresolved and perhaps unresolvable. As incumbents move up market, they leave the bottom of the market ripe for disruption. Small funds, disciplined early-stage investors, and emerging managers are the ones filling the gap. Because of our fund sizes, fees are tiny. This sector of the market makes money off the carry, not the fee, in perfect alignment with our LPs. This observation from a smaller fund manager captures the fundamental challenge. A16z has become the incumbent they once disrupted. The ongoing narrative of software eating the world has evolved into something more complex. Software did eat the world, but now AI is eating software. Crypto is eating money, and the feast has become a free-for-all where the winners are far from determined. A16z's ability to navigate these platform shifts while maintaining strategic coherence is impressive, but it raises questions about focus and identity. Are they a venture firm, a private equity shop, a crypto fund, an AI investor, or something entirely new? The answer might be that these categories themselves are becoming obsolete. What the next decade holds depends largely on whether a16z can maintain the delicate balance between scale and agility, between platform and flexibility, between supporting entrepreneurs and generating returns. Their transformation into an RIA suggests they're betting on a future where these traditional boundaries dissolve entirely. They're not just investing in the future, they're trying to build the infrastructure through which that future will be financed. The human element remains central despite all the talk of platforms and systems. Marc Andreessen's evolution, from programmer to entrepreneur to investor to philosopher king of Silicon Valley, mirrors the industry's own journey. Ben Horowitz's transformation from operator to investor to author to cultural commentator reflects how technology has moved from the periphery to the center of business and society. Their personal journeys are inseparable from a16z's institutional evolution. The ecosystem impact extends far beyond direct investments. Thousands of entrepreneurs have been influenced by a16z's philosophy, approach, and advocacy. The firm's portfolio companies employ hundreds of thousands of people, serve billions of customers, and have created trillions in market value. The ideas they've promoted, from software eating the world to it's time to build, have shaped how an entire generation thinks about technology and business. Critics argue that a16z represents the financialization of innovation, that they've turned entrepreneurship into a game of raising ever larger rounds at ever higher valuations. There's truth to this criticism. The firm's success has contributed to an environment where fundraising prowess sometimes matters more than business fundamentals, where narrative can override numbers, where the ability to raise from a16z becomes a signal that replaces actual traction. Yet the counter-argument is equally compelling. In a world where technology determines economic, political, and social outcomes, having a sophisticated institution dedicated to accelerating technological development serves crucial societal functions. A16z doesn't just fund companies, they systematically reduce the friction of innovation. In an era where America's technological leadership faces challenges from around the globe, institutions like a16z might be essential competitive advantages. The financial returns versus ecosystem impact debate misses the point. A16z's greatest achievement might be proving that these aren't mutually exclusive, that you can build a massive, profitable institution while genuinely advancing technological progress. Whether this model is sustainable as they continue to scale remains to be seen, but the attempt itself has been transformative. Looking back from some future vantage point, Andreessen Horowitz will likely be seen as a bridge between two eras of innovation financing. They took the venture capital model invented in the 1960s and adapted it for the internet age, then adapted it again for the platform age, and are now adapting it once more for whatever comes next. They didn't just ride the waves of technological change, they helped create them. The story of software eating the world has become the story of a16z eating venture capital, transforming it from within and potentially transcending it entirely. Whether that transformation ultimately serves entrepreneurs, investors, and society better than what came before remains an open question. What's certain is that the experiment continues. The scale grows larger and the stakes get higher with each passing year. In Silicon Valley, where the future is always being invented, Andreessen Horowitz has positioned itself not just to fund that future, but to fundamentally shape what it becomes.
This podcast is brought to you by empor.top, the stories of top companies. Disclaimer: this AI-generated content is for informational purposes only and should not be considered as investment advice.